If you look at where the price of gold was when the Federal Reserve came into existence, you needed $20, 20 Federal Reserve notes to buy an ounce of gold. Now you need almost 2,000. It's 1,900 and change, but let's just call it 2,000. That means that the dollar or the Federal Reserve note has lost 95% of its purchasing power. No, 99% of its purchasing power, because you need 100 times as many dollars to buy an ounce of gold today as you did when they established the Federal Reserve.
PeterSchiff, a prominent figure in finance and economics, serves as the CEO and chief global strategist of Euro-Pacific Capital. The effects of ongoing inflation created by the Federal Reserve for more than 100 years have led to a loss of purchasing power in the US dollar amounting to 99%. The severed historical link between the US dollar and gold is a subject of discussion. However, Schiff asserts this connection no longer exists. The latest Kitco News weekly gold survey shows optimism fled the precious metals market last week, as less than half of retail investors expect gold prices to post gains next week, while most market analysts return to their bearish bias. Sean Lusk, co-director of Commercial Hedging at Walsh Trading, said gold's performance is still all about the US dollar, and he doesn't see the greenback weakening anytime soon. PeterSchiff observes that since 1971, the U.S. Federal Reserve notes no longer promised, breaking from the gold standard and relying on market forces. The collapse of the Bretton Woods system in 1971 merely acknowledged the prevailing reality: the connection to gold was a sham. By 1973, all central banks declared themselves free to manipulate their currencies. As a result, between 1971 and 2023, the dollar depreciated by 87%. Now, we are presenting you a glimpse of PeterSchiff's insights from his recent interview with Rafi Farber. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
There's no longer any link, really, to what we call the dollar and gold. Now, what we call the dollar is a Federal Reserve note, but it's not even a legitimate Federal Reserve note because a note promises to pay something. Now, once upon a time, when the Federal Reserve began in 1913, the Federal Reserve notes did promise to pay something. They promised to pay dollars. What was a dollar? A dollar was defined as a weight of gold or silver. So Federal Reserve notes were liabilities of the Fed, where they promised to pay the bearer on demand real dollars. But those Federal Reserve notes could circulate in commerce as a medium of exchange, as a substitute for those dollars. That's why they're a money substitute. Currency, by definition, is a money substitute. It's currency backed by real money, because real money has to have intrinsic value. That's one of the properties that money has to have. It needs to be a store of value. So a piece of paper doesn't store anything. What gave the Federal Reserve notes value is the fact that they represented ownership of real money, dollars, that were a defined weight of gold or silver. When the Federal Reserve note initially came out, $20 was 1 ounce of gold. That's literally what it was. And so if you had a $20 bill, it was a Federal Reserve note that obligated the Federal Reserve to give you an ounce of gold. You know, it had a coin, like a U.S. government coin that it minted, and you got that for your 20. But now you don't get anything. If you have a 20, they'll give you two 10s or 4 5s, but you're not going to get any real money. You're just going to get another piece of worthless paper. Now, ever since we went off the gold standard officially in 1971, and those Federal Reserve notes were just worth whatever the market would bear, people still ascribe value to Federal Reserve notes because other people will accept them in payment for goods and services. And of course, the government requires that taxes be paid in those notes. And so since most people don't want to go to jail, they need to accumulate these Federal Reserve notes to pay their taxes. And so that's basically what the system is built on. It's built on confidence and government force, because the government forces us to pay taxes in this currency. You can't pay your taxes in anything else. Even if you have gold or silver or if you have euros or Swiss francs or Japanese yen, you can't pay your taxes with those currencies. The US government doesn't accept them. You have to sell those currencies or sell that metal to get dollars, Federal Reserve notes, and then you can pay your taxes.
Moving forward, PeterSchiff anticipates significant US dollar devaluation, while he doesn't predict hyperinflation as inevitable. Around 70 foreign exchange strategists foresee a modest weakening of the dollar against major currencies over the next year, primarily expected to occur next year as the first Fed interest rate cut approaches. Meanwhile, Schiff believes that Nixon's failure to maintain the gold standard while devaluing the dollar could have potentially averted the financial challenges. In 1971, President Richard Nixon decided to suspend the convertibility of the US dollar into gold, effectively ending the Bretton Woods system. This move marked a significant shift in the international monetary system and had far-reaching consequences. Let's get back to the interview.
Well, hyperinflation is not inevitable, and I would still think that it's more likely that we won't end with hyperinflation. But I think that there's going to be very high inflation. There's no question about that. So the dollar won't lose 100% of its value, but it could lose 50% of its value very easily. It could lose 70 or 80% or maybe even 90% of its value without going to zero. But in order to prevent the dollar from going to zero, eventually the government is going to have to do the right thing. Now, the longer it waits to do the right thing, the closer to zero we're going to come before they finally do the right thing. But doing the right thing is going to involve a lot of, short-term pain, although we're probably going to have a lot of short-term pain before they even have a catalyst to do the right thing. But, they're going to have to let people lose money. They're going to have to let companies fail, banks fail, depositors lose money. They're going to have to be honest and cut benefits like Social Security and Medicare and government pensions and cut national defense. They're going to have to act fiscally responsibly, something that they've never done. And the reason they don't want to do it is because the voters don't like it. Well, they're not going to like massive inflation either. But at some point, if we want to prevent, hyperinflation, which would be the worst possible outcome, then politicians and the Fed, they're going to have to do the opposite of what they've been doing. And that is, act responsibly. So interest rates need to be much higher than they are now. And that means a lot of debts are going to go into default. And a lot of people are going to lose money because they can't get paid. Where Nixon could have done the right thing and stayed on the gold standard. And he could have devalued the dollar a bit, but stayed on the gold standard, cut government spending, told people we can't have guns and butter. We're going to have to cut back on some of this spending from the Great Society and these programs. But no, he chose not to do that. And here we are 50 years later, the problems are much worse because back in 1971, the US was still the world's largest creditor nation. Now we're the world's biggest debtor nation. Back then, we had huge trade surpluses. Now we have massive trade deficits. So all of this is the consequence of 50 years of kicking a can down the road.
The future of the US dollar and its relationship with gold remains uncertain, with differing viewpoints on the potential consequences of further devaluation. Coin price forecast experts' gold rate prediction 2023 is around $2,030. The upward trend will continue in 2024. Analysts expect gold to rise to $2,032 in the year's first half. By the end of 2024, the XAU-USD price will be around $2,100 per troy ounce. How might the US dollar devaluation and the shift from the gold standard impact global economics and investment strategies? Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more exciting topics. Thank you for watching.